Let's run through some forecasting and projection multiple choice questions. Getting started, sales forecasts are formed considering all of the following factors except which? Well, let's see. Let's start from the bottom. What about competitor plans? Okay, well, if you are Apple, if Samsung comes out with a hit phone and all of a sudden you lose some market share in what you're selling, you can bet yourself that you are going to adjust your sales forecast and say we'll probably sell less iPhones in this period. Competitor plans would be considered, and as such, not the answer here. What about past historical sales data? Well, if we think about this here, past results are not indicative of future results. However, if you generally sell a certain amount of product during the month of December versus January, or your sales trends have been going up by 5% each year, past historical sales data, it's a pretty good place to look. Estimates of future sales, that's what a sales forecast essentially is. So this is something as well that would be considered. However, sunk costs are not going to be considered here. There is no recuperating a sunk cost. Once it is spent, it is done. It's over. And as such, wouldn't play a role in any forecasts. All right, think about sunk costs. In your own personal life, maybe you went out to dinner with a friend and you are not friends with that friend anymore. It's a sunk cost, unless you had a really good meal. Hope you did. All right, next question. Last year, a segment of Dixon Company had the following sales, assets, and operating income. We had sales of 500, assets of 200, operating income of 50. What is the segment's asset turnover? Well, just as we would with any question that specifically calls out a particular formula, I'm going to write this out. And the asset turnover ratio, you should definitely have this memorized. If you don't, no worries, here it is. That is sales divided by assets. So this question is as simple as 500,000 divided by 200,000. That is going to get us a result of 2.5, which is letter B. I love these questions and love bringing them to your attention because it is absolutely mind-boggling how many questions you'll see in the exam that are just straight memorization based. And I'm telling you from experience, not enough people memorize all the formulas you need to know. We've got formula sheets, study guides, all the formulas you see need to be memorized. And to be honest, there's at minimum 20 pages of formulas to memorize. Now, yes, that sounds like a lot. However, when you realize that once it's done and memorized, and it's very doable, I've done it and I know plenty of people to have done it themselves, it's like 3 points in the exam. For questions like this, you just need to have it memorized and boom, you got it. Now, do I agree it's annoying? Oh, for sure. It's super annoying that it's just this plug and chug memorization game. But that's what you're here for. You're here to get the CPA license, right? You're here to pass the test. Talking a little bit more about the asset turnover ratio, it measures the value of a company's sales or revenues relative to the value of its assets. So the higher asset turnover ratio, the more efficient the company is at generating revenue from its assets. If I give a company millions and millions of dollars of machinery, but they're not, they've got maybe a 0.5 asset turnover ratio or a 1, something like that, means they're not really using their assets, their equipment, their machinery as efficiently as this company that's 2.5 times. Next up, we've got a decent size question here. So I am going to go ahead and read the question first. What price must Milo charge Adobe to obtain a 20% markup on variable manufacturing costs? All right, a lot going on here. Milo Corp sells washers for $350 per unit and incurs product costs of $300. Prime costs for the washers are $150 and the fixed portion of the overhead is $90. Milo receives a special order for 2,000 washers from Adobe. Additional variable manufacturing costs to meet Adobe specifications are $40 per unit. Milo has sufficient excess capacity, you can't take this project on unless you do, and has determined that this sale will not interfere with regular business. That's also important. Glad we have that there. We need to determine what price that we need to charge in order to get a 20% markup on variable manufacturing costs. Okay. With that being said, we're going to use some formulas. We're going to talk this through. Now here, when we're making a decision in this decision-making process, the most important factors are going to be the variable cost and the market price, right? Because what are you charging versus what are you going to incur as costs per item? Fixed costs, they're set, right? Regardless of what's going on, you are paying your fixed costs. Regardless of if you accept this new project or not, you have those incurred. And keep all of this in mind for the question. If Milo has excess capacity, which we see, that means that Milo has enough capacity to accommodate more orders. The minimum price that Milo can charge is going to be the variable cost per unit, right? Because that's break even. And the maximum price it can charge is the market price, because if you charge more than the market price, this Adobe entity is going to go somewhere else. If Milo is operating at full capacity, then the minimum and maximum price it will charge is the market price, because you need to essentially be able to break even, right? Here, Milo is operating at excess capacity, as it says here, sufficient excess capacity. Therefore, it cannot charge market price. We have now a couple numbers that we're going to run through. So product cost is $300 right here. And we've seen before that product costs, another name for that is cost of goods manufactured, and another name for that is direct labor plus direct materials plus overhead. That equals 300. Super important to bring all our formulas out. Okay, now, as I said before, what's important here? The variable cost and market price. Well, variable manufacturing cost, what's that going to be? Well, that's going to be actually 210. Where do we get that? 300 of total product cost, take out the overhead right here. Take out this overhead of 90, leaves us with variable manufacturing cost of 210. So if Milo accepts these additional orders, additional information, we're going to have $40 per unit of additional costs. The total manufacturing variable cost as such is going to be 210 plus 40 for a total of $250. Great. Now, additionally, we want to charge a markup of, what did it say, 20%. So this 250 times 20%, actually not times 20%, times 1.2, right? Because that's how we're going to account for that markup. So 250 times 1.2, that's going to get us back to 300. Not 200, 300. All right. Right there. Awesome. So that $300 is our answer. That $300 is the variable cost we're charging as well as the markup. We broke it down, right? We got rid of the fixed overhead. Let's recap what we did. Got rid of the fixed overhead, got it down to 210. That's the variable cost per unit. Added in 40, which comes just from this particular project, getting us to 250. Then we are charging a markup. Why is that? Just because, right? That's just kind of what we're doing here. There could be other criteria. Maybe you want a little bit more profit from this project. Maybe it's because there's a risk with this project. There's many reasons why there could be a markup. So final answer here is going to be $300, and that is our price that Milo must charge Adobe to obtain a 20% markup on variable manufacturing costs. Yeah, definitely a pretty involved question. Hope you enjoyed it. I know I did as well. And let's wrap it up with the last one. In year one, a company's cash is 15% of sales. Well, let me read the question first. What amount would be the required net working capital in year two? All right, well, we have to dive in a little bit. We're dealing more so with our current assets, current liabilities, dealing with working capital. And our formula for net working capital, another one to memorize, net working capital is going to be, like I said, current assets minus current liabilities. Great. Now let's dive in there. Let's figure out all of our current assets and our current liabilities in year two. It's net working capital in year two. Well, okay, we've got a couple numbers, and 15% of sales, so cash is 15% of sales, AR is 10% of sales. Okay, so obviously we've got a lot of numbers that are deriving their value off of sales. Now there's two ways to go about this. We have our sales. We have a bunch of percentages based on sales. We are concerned with $55,000 and $50,000 is year one, but we want year two working capital. There's two ways to go about this. You could do 15% of sales, 15% of 55 plus 10% of 55. That's the long way to do it. Now, what I would actually do here is you can take 15%, that's cash, then plus 10%, that's from AR, plus inventory, another current asset there, 20%, and then accounts payable is 30% of sales, so minus 30%. See what I did there? That is a much quicker way than doing all the multiplication together. We're just adding these all together, or summing these all together rather, not all adding there. Minus 30, so that gets us to 15%, equals total of 15%. As such, we are going to just simply do 15% times $55,000. Again, you could do it the long way. You could do 15% of 55, 10% of 55, do all that and sum it together. I'm not going to do that. I'm going to save a little time here. So 15% of 55,000 gets us to $8,250. Final answer is letter A. Key takeaways here: memorize a formula, find ways to save time. Although don't be too worried about time, right? Like this isn't FAR. FAR is a test we're going to be much more worried about time. Focus on getting them right. I mean, don't spend 5 minutes per multiple choice question, but if you're finding yourself getting these done in 2 minutes, I think that's pretty solid for now. So working capital, also known as net working capital, right? It's current assets minus current liabilities. This is a measure of a company's liquidity, and it is going to determine how liquid you are as a company, right? Can you pay your bills? Obviously, you want a positive net working capital. That's super important. Final answer, $8,250. Good. That was a good couple of questions on forecasting and projection, and thank you all for joining. Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.exempprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.exempprep.ai and let's achieve your exam success together.